It's just that when I'm
Okay.
traveling that I don't record
Okay, that's good.
it. Yeah. Okay, so let's start with a few basics. So we have Sandeep from credit risk side, right? So what I wanted to do was I wanted to start a little bit with what is credit risk. Uh, Last time we have seen that XVA has two. I mean, if we are talking about, let us say, CVA, right? Within XVA, right? Within that, if you are talking about CVA, so credit valuation adjustment. So we saw kind of last time that any kind of XVA is a combination of market risk and credit risk, right? So this is credit risk, and we have market risk. So we will see individually what how these components are there in CVA, and then we'll actually go into the credit valuation adjustment by one of the well-known regulator, which is so the name of the regulator is BIS, Bank of International Settlement, which has released guidelines for FRTB, which is Fundamental Review of Trading Book. So they have a certain set of guidelines as to how do you compute CVA. We'll delve into that. Yeah, we will see depending on how many basics we can cover today and how much time we have to jump into that paper. But
Ajit, is this the link you shared on the group?
yes,
I
it's the
think
same link.
today or yesterday.
Yes,
Okay,
yes.
yeah, there was a very confusing link, so please do explain it.
Yeah, yeah. So it has a lot of details, and that was one of the point which I wanted to make was right. So if you are working, so if you are a quant, if you are XVA quant, right? XVA quant working for some kind of XVA development, right? Maybe for CVA. Then what will happen is you will get such a white paper. So you'll get a white paper from regulators, okay? And that white paper will in detail talk about how to implement a particular methodology, right? For example, CV, how to implement it. Your job will be to understand that white paper, go through all the details of it, implement it, and because what will happen is after you implement all the details of that white paper, it will go back to regulators. You'll have to build an ecosystem. So this is how it will work. Okay, let me put a flow diagram. So regulators, these are regulators, right? I'm talking about so most of these regulations are applicable for investment bank, not really for hedge funds and all of that, but they can also use this same methodology. But this is how the flow looks like. So you have regulators, right? In this case, the regulator is BIS, Bank of International Settlements. So I think people who are not talking can go on mute. So you have regulators who mention, what are the guidelines and how do you build an ecosystem around, and so on and so forth. Okay, that is the first step. The so first regulators define what is the framework. So let me brush it off and let us start again. So we have so regulators define the framework. Okay, this framework itself is developed in consultation with major uh, what should I say, industry experts for a particular industry, and they would be uh, giving their inputs, and how a particular thing should look like and all of that. A sample framework looks like this, right? So let me open a PDF version of it. So this is how they put it, right? So this is effective as of 1st Jan 2023, last updated 8 July. Okay, there'll be consultations, there'll be white papers which will be published by them, then industry experts will give their opinions, they'll say this works, that doesn't work, this is good, that's not good, and all of that, right? And after a lot of consultation, they will come up with a white paper like this. Okay, so this is the finalized version of a white paper. This is published by Bank of International Settlements. So this is one of the regulators, right? And the regulation for which they are proposing the regulation or is essentially calculation of risk weighted assets for market risk. Within that, there is a subtopic called as credit valuation adjustment framework, and then there is a very lengthy white paper. Okay, it starts with definition. Okay, what is a risk weighted asset, what is the credit CVA risk, and all of that. Okay, so very specifically, very clearly, very transparently, they'll be defining each and everything. Okay, what is the meaning of capital requirements for CVA and all of that. So we are not going through this white paper yet to understand the white paper. I'm just kind of explaining that there is something called as a white paper for everything which is implemented in the risk management domain of an investment bank. I'm just walking through a sample white paper. Okay, so here they will define every small thing. Okay, what are the formulas, okay, and all of that. Generally they'll also provide some example sheets as well. There could be Excel sheets and implementation sheets and all of that. We have those as well. We will look at that. I'm trying to see the online free sources for that. But let us say, so this is how it looks like, right? The regulators have defined framework with after long deliberation and consultations with industry experts, right? So if let us say you have spent 20 years in the industry and you are within an investment bank and all, so you will be one of those industry expert who will be contributing to building one of the frameworks which could be in some domain, right? Depending on your competency and the domain what is required. It could be credit risk, market risk, and so on and so forth. So regulators build a framework and they give so this in terms of understanding what this framework is, right? This is kind of an algorithm, right? So explicitly written algorithm. Okay, so it has steps as to how to do a certain calculation and all of that. Okay, so this framework is that. Now this white paper needs to be read again by the quants which sit within a bank. Okay, because many quants would have provided, many quants from different uh, uh, investment banks would have provided their inputs and all. So quants within the investment bank has to sit and read through thoroughly all of this white paper. Okay, so it will be one person or a group of people who will be going through each and every step which is written, every definition what is written and all of that. Then what happens is then we have some parallel streams. So these quants will kind of give certain guidelines and understanding about how to build an IT infrastructure around it. Okay, so building of IT infrastructure. Okay, what are the databases? What kind of data is required? Where do we store the data and all? How to pull it? Okay, and okay, and so on and so forth. So there is an IT infrastructure to be built around it. Then you have a certain what can I call? It could be upgrades to their existing quant libraries. So here you have quant libraries, right? So this is purely related to data and information, right? This is related to programming, architecture, and building of your uh, system, right? So this is system building. Okay. So for example, for CVA, you need a CVA calculator and all of that. That CVA might require access to pricing libraries which already exist. And there are some things which are within CVA framework which need to be built from scratch and all of that. All of that is part of quant dev kind of work, right? So developers, so these are quant devs. They may not know all the things which exist in quant and all of that, right? But uh, but they need to know how to code robustly and understand the requirements and and code it out. Okay, so that is one thing. Then you have in parallel, in conjunction, you have a quant research team, right? So you have a quant research team. These quant research will, so this large piece of white paper will be broken down into smaller parts and all, so you can let us say call them modules. So one module each will be understood well by the quant research team, maybe even implemented in Excel and all of that, and have an understanding build which can be transferred over to The quant development side, the quant development will ensure that the correct IT infrastructure is present and provide the feedback or need to develop whatever infrastructure is not present. Then these people will implement. So quant dev will implement all of that in a certain Python code and all. Whatever implementation is presented, so this is implementation which is shared with back with researchers. Then these researchers will validate that implementation and say that it's going well and all of that. When everybody agrees on it, this particular system goes to production, right? So this goes to production. Okay, and on daily basis, it is governed parallelly by model governance team and all. So model governance will will govern everything from here to here, right? So here what we have is this is kind of development of a new system. This is development of a new system. This part is productionizing it, right? So here comes the middle office part of it. So here you have an ops team. Here you have ops team who ensure that on daily basis the data is pulled correctly, it is implemented correctly. If there are any issues, they talk with these people. And if there are any major issues in terms of uh, understanding or in, so here also you kind of requires a few quant people, because what will happen is on day or day basis, if you observe something which logically does not make sense, right? If something is supposed to go up but it's not going, and mathematically does not make sense, then this will be identified and relayed back to quant research team, and quant research will take a look at all the issues which are being highlighted. Okay. And model governance will keep checking that on daily basis, whatever model performance was expected, whether it is matched or not. So I mean, they check in the sense, operations provide the evidence to model governance team, that and then model governance team, as per the limitations and whatever were set while development, that this was the performance metrics of this model. But whether or not that model has performed well or not, it will ask operations team to maintain the data, and then these model governance guys will do an audit that whether that model is performing good or not. If it is not performing, whether it is due to a bad implementation, whether it is due to some bad assumptions and all of that, and then that model might require some redevelopment and all of that. Okay. So this is roughly a very high level picture of what happens when a new regulatory framework is released. Okay. And then we have quant research, IT teams, and all of these things, then middle offices and productions, and then you have back offices. Okay. So I hope so. Back offices, will use, so for example, in context of CVA, right? So this is a middle office kind of work stream. This is a front office work stream. And then you have back office. Back office will actually be calculating CVA on daily basis and making sure that that CVA is incorporated into the price of the trade. So here, if you have trade matching and reconciliation and confirmation. Okay. So as part of the price of the trade, apart from using something from Black-Scholes model and all of that, whether CVA cost was included and whether the cost was appropriately charged to the treasury and all, this is what the record of which back office will keep. Okay. So you have back office, middle office, front office, and so on and so forth. Okay. Are there any questions within this?
Not really from my end. It's pretty much clear.
Right. So uh, this is how. So if you are a quant, right, and the kind of sessions which you are having will largely be placed here, will largely be placed here, and maybe once you have some 15-20 years of experience, will be placed here. Okay. But this is how the workflow looks like. Now, coming back to the credit valuation adjustment. Even before that, we are looking at something called as credit risk, right? So let us look at credit risk, and then what element of that has market risk, and why is there an overlap, and why do we call uh, why do we land up here in terms of CVA? Okay, this is required for even to understand this white paper, because there are a few things which kind of assume that that, right? So I think I just saw one of it, but uh, yeah. So some kind of probability of defaults and all of that. Okay, so let us come back to that. Okay, so if you look at any kind of credit risk, okay, credit risk exists. So credit, just because we are seeing it in the quant context, it does not mean that credit risk exists only in quant context. Okay, so credit risk has many faces in that sense. Okay, so this exists even for a retail bank. Okay, so for a retail bank, this will be there. Then uh, you have a wholesale side of it. Okay, and then you have investment bank side of it. Okay, credit risk in context of retail bank, what it means is, if so uh, example, right? So if somebody has given a loan to someone, right? For example, a retailer takes a home loan. Okay, the bank faces a credit risk that this guy might default, or even prepayment is a risk, but we'll discuss that on a separate day. So a guy who has taken a loan from a retail bank might not pay back the loan. So there is a certain expected loss associated with it. Okay, there is certain expected loss associated with it. So this is popularly given by PD into LGD into EAD. Okay, so this is expected loss, right? So this is a very standard base equation for credit risk. So any kind of credit risk you will never have uh, without this equation. Okay, so this is what that equations look like. So expected loss is equal to probability of default into loss given default and exposure at default, right? So for example, if you have taken a loan of I don't know, let us say 100 rupees from bank, home loan, right? So there is a certain probability associated with your default, right? So there is a probability of default, and uh, so and then there is loss given default. Loss given default means, let us say you have taken a loan of 100 rupees, right? And you took that for 10 years, and just for sake of simplicity, let us assume that you are paying back 100 rupees each year. Okay, then let us say you default after 5 years. Then the exposure at default, okay, at the point that you're defaulting, the residual exposure is the rest 500 rupees, correct? So the exposure at default is 500 rupees. Now whether or not you default after 5 years, that has a certain probability associated with it, 2%, 5%, 10%, whatever. So that is that probability of default. And loss given default is after you have defaulted, the bank will take over the collateral, let us say your mortgage, which is house, and they'll sell that collateral. They may or may not recover the full value of that outstanding amount, right? So loss given default is it comes from recovery rate. So recovery rate is generally assumed as 40% and all, not for home loans, but generally in credit risk. So it is assumed that 40% is the recovery rate, and recovery rate is equal to 1 minus loss given default, right? So if 40% is recovery rate, then loss given default is 60%. So 60% of, so let us say probability of default is 2%. So 2% into 1 minus 40%, okay, into exposure of default is residual 500 rupees. So this is called as expected loss. Okay, and banks have to set aside this much amount of capital each year, to compensate for the fact that people could be defaulting on home loans and all of that. So at a very high level, this is how credit risk looks in a retail bank. So you require a model for probability of default, right? So use a statistical model for this, use statistical model for this, and so on and so forth, right? Now, in wholesale context, what happens is there are rating agencies which assign ratings to institutions, right? So we keep hearing that this is a AAA institution, this is a AA institution, and all of that, right? Here also the formula of expected credit loss remains same, but here the probability of default comes from the ratings. Okay, and then so if there are institutions, there's a transaction between two institutions. Okay, so let us say institution one has issued bonds and institution two has subscribed to those bonds, right? then institution one faces, so institution two faces credit loss risk, and that credit loss risk again comes from PD, LGD, EAD. Okay. So if the bond was for 10 years, 5 years have gone, then what is the residual exposure and all of that, right? So exposure, you have probability of default, that a guy could default, that comes from ratings and using looking at the financial statements and all of that. Okay. So this is a very brief overview of credit risk in context of retail and wholesale. But that's not what we are looking at. I'm just giving you a background that credit risk, despite the fact that we might be learning in investment bank and derivatives context, but credit risk is a pervasive risk. It generally exists at a lot of other places. And these are the examples of what it means in terms of credit risk or existence of credit risk in other places. Okay. Now let us come back to investment and what we are talking in terms of credit risk, in terms of credit valuation adjustment. Okay. Let us say two people A and B have entered into a derivatives transaction, right? And you know uh, from so they entered a transaction at t is equal to 0, and the contract exists at, let us say, t is equal to 1 month, right? Now between 0 to 1 month, for the derivative transaction which was entered between A and B, what can happen is, A can default to B, B can default to A, and so on and so forth. But let us look at the transaction from A's perspective, right? So let us say they entered into a transaction. Okay. And let us say A was long on a call option, or something like that, right? So this is an underlying, right? And this is a simulation of various uh, prices based on Monte Carlo simulation and all, and you generate, what all stock prices that underlying can go. Based on that underlying, you find what all values the derivative can take, right? Now, what happens at, so there can be, so so if so looking from A's perspective, right? From A's perspective, what is the risk for A? The risk for A is, on certain days when A has won the trade, okay, or is a net positive PNL for net positive PNL for A, okay, and B refuses to pay that. That is the default risk. That is the credit risk that we are talking about. Correct. So at many instances, okay, so here you have discrete time instances, or you have at the expiry of trade. For sake of simplicity, let us just talk about expiry of trade at t equal to 1 month. Okay. So since A was long on the option and or the derivative, so let us say this is S is equal to K. Okay. And this is in the money. Okay. And this is out of the money. Okay. So this is the region where A is worried that A has kind of won the bet, right? But B will not pay up, right? So this is the region where B is supposed to pay to A and B might not pay to A. Okay. So this is called as uh, potential future exposure, or kind of positive exposure which B has to A, right? So this is the money. So this is kind of an exposure at default. Okay. So let us say at t equal to 1 month, B defaults towards A. So these are the instances, or these are the exposures where there is a risk that A has won the bet, but it's not going to get paid. Okay. So uh, this exposure to default comes from the fact, so comes from the conditional exposure, right? Wherever it is in the money, only that it is worried about. Out of the money, anyways, A has lost the bet, right? So in all those cases, it is B who is worried about whether or not A will pay. That's not a risk from A's perspective. The risk from A's perspective is A has won the bet, but B will not pay up that amount of capital, right? Now, this, in context of credit risk, is what is exposure at default. But now you understand that this exposure itself comes from market risk. Okay. Because this exposure depends upon how the underlying risk factor on which the derivative has been defined that moves. Okay. So it can move whatever, up, down, it can move Gaussian and all of that, right? That is why, so if you have a credit risk component in derivatives market, That, if again, like I said, credit risk is simply defined as PD LGD into EAD, right? So here the probability of default means that B defaults on payment. Okay, that depends on, you know, uh, let us say there are many ways to compute probability of default. I don't know how many of you are aware there is something called as a 5-year credit default swap on entities, right? So let us say there is a 5-year CDS on, so 5-year CDS probability of default, let us say Japan. Okay, so there is a instrument which is called as a 5-year CDS. Okay, and using that is just like, if you have a price of uh, an option, and using that price of an option you can calculate the implied volatility. Similarly, using price of the CDS, you can calculate what is the implied probability of default of a particular entity, right? So if Japan has a government bond issued which has a credit 5-year CDS spread at 21.96 units, whatever it's dollar or something like that. Okay, then the corresponding implied probability of default from that is 0.37%. Okay, so this is one of the ways to get the probability of defaults. Okay, so you have a hazard function and all of that, right? And from Poisson processes and all, and you can back calculate as to what is the implied probability of default. So that is that recovery rate, like I said, is assumed to be at 40%. Okay, so recovery rate, so that's why loss given default is assumed to be at 60%. And exposure at default, this comes from market risk, correct? So this comes from how the underlying variables which are involved in the derivative pricing, how do they move, or these factors, how do they evolve over a period of time. So if you have an option on Nifty is an underlying collection of, it's an index. So how the Nifty index moves over next 1 month, that will decide what will be the exposure at the end of 1 month. Correct. So, and probability of default will come from CDS spreads or many other models, right? So this part of the element comes from a very hardcore credit risk modeling. This part of the component comes from very hardcore credit risk modeling. This is kind of a constant in most cases, and this component comes from the market risk element of it. Okay, that is why XVA is a combination of credit risk, credit risk, market risk, and uh, credit risk and market risk. Correct. Any questions so far?
So, Ajit, in this equation,
Yeah.
there is an echo. Yeah. In this equation, the PD is given to us already, right?
No,
That's
no,
what you
nothing.
were trying to
Nothing
point
is
out.
given. Nothing is given.
Like, in the sense, it's a constant. Sorry.
LGD is a constant. PD needs
Okay.
to be
LP
found
is
out.
a
Yeah.
and okay, fair.
Okay. So PD needs to be found out. Okay. Let us try to find. I somewhere saw that equation here in this white paper. Let me just try to find that.
So, Ajit, while you're finding the equation, I have a general kind of a question.
Yeah.
The zero sum assumption that we have taken, right? That
Yeah.
this entire trade is a zero sum game.
Yeah.
Does it actually hold when you're trading in real life? Like, can
No,
you
that's not
truly
an
rely
assumption.
on this assumption?
That's not an assumption, right? What do you understand by zero sum?
One party, if one party wins, the other loses.
Yeah. So
So,
what is the
okay.
assumption about that?
No, what I'm asking here is since we are entire when A is trying to like decide for B's default.
Yeah.
So, do they just plan? Okay, so basically they plan around independent trade, right? They are not concerned about rest of these businesses. They're
No,
solely
so
concerned on
yeah,
whether or
no,
not
no,
in
so
that trade are they safe.
no, it is for the portfolio. Okay, A has exposure to B of a portfolio of trades. It's not a single trade.
Okay.
Okay, so A's exposure to B. I gave an example for a single trade, but A has exposure to B for a portfolio of trades. Okay, it can be any kinds of trades. Okay, and all I mean OTC trades. Okay, because
Yeah.
exchange traded trades go via CCPs or
Yes.
exchanges, and those exchanges are not subject to this regulation, which we saw the last time also, right?
Yes,
We
yes, yes. I
we were
remember.
reading on Wikipedia, and it said that this is applicable only for OTC trades, which are bilateral, okay, between A and B, correct? But that can be between any asset class. Popularly, there are five asset classes. There is equity, okay. There is credit. There is commodity. Then there are interest rates, and there is FX. These are five major asset classes, right? So
Okay.
A can have exposure to B in any or all of these asset classes. So I have 20 trades in equity, 5 trades in credit, I have 15 trades in commodity, right? 60 trades in
Understood.
IR and 100 trades in FX. For all this netting set, okay, I will charge a CVA risk. Okay, so
Okay.
that's what I were referring to. If you look back at the white paper,
Okay, so the charging is done on accumulation. Okay, that makes sense.
yes. So like we see here, right? There is something called as risk RWC. Okay, so this is the roughly the equation we are looking at, which is equivalent to what we were looking for now, right?
Yeah.
Which is exposure at default and all of that. So let us try to look at these things one by one. RWC is the risk weight for the counterparty C that reflects the volatility of its credit spread. Okay, these risk weights are based on combination of sector and credit quality of the counterparty as prescribed. Okay, so
Oh,
let us look at that. Okay, so this is how it looks like, right? So for example, uh, for sake of simplicity of calculation and all of that, what FRTB has done is it will classify a counterparty based on the sector, right? Healthcare, IT, banking, and all of that, right? And something else. So they have a certain risk weights defined on that. Okay, so they have directly come up with a certain risk weight. Okay, that you are going to use this number for this calculation and all of that. I hope you understand,
okay.
right?
Yeah. So, in very simplified terms, if I were to talk about this,
Yes,
this is just depending on different asset classes, you're taking a weighted average over all the risks.
yes. See,
Perfect.
if
Yeah.
the sector of the counterparty, okay, it's a sovereign, right, including central banks and multilateral development banks, right? Then there are credit quality of counterparty, right? So there is investment grade and there is a high yield or non-rated. Okay, so what that means is, so India has a certain rating, right? India has a
Yes.
triple B rating, maybe US has a double A rating and all of that. If Indian central bank will be classified as high yield or non-rated. So India will be classified as a high yield. Okay,
Okay.
something as investment grade is something above, I don't know, maybe double A. I don't know exactly. Okay, but just for sake of a
Yeah.
discussion, let us assume that something is investment grade, which is higher quality. Triple A, double A, all of those are investment grade. Okay, so if the counterparty is RBI, right? So it's a sovereign central bank which is high yield, correct? Then the credit
Yeah.
quality will be 2%. So this is the risk weight that will be used for that.
Okay.
Okay, if it is financials, right, including government backed financials. So if it is between JP Morgan and Goldman Sachs, right, which are investment grade, right? So
Yes.
uh, so for that we use 5%.
Okay.
Okay, now if it is financials but which are high yield, right, then that will be 12%.
Okay.
Okay, then basic materials, energy, agriculture, mining, 3% or 7%. Okay, so they have done their historical analysis, and this is what they have found out, that this is the
Understood.
kind of mapping that they'll use. Okay, then next element is MNS, right? MNS is the effective maturity of the netting set. So for banks that has supervisory approval to use internal model, MNS is calculated as per so and so, with exception to the 5-year cap in this. For banks that do not have, then it is as per so and with 5-year cap which is not applied. Let us try to see this. I have not seen this either. Okay, so this is how it is computed. Okay, so if the original maturity of the longest dated contract contained in the set is greater than 1 year, then the formula for effective maturity is reflect with formula that is as follows, where DFK is a risk-free discount factor for the future time period, and remaining symbols are as defined above. We'll see this, but in short, there is a certain formula for it. Okay, so
Understood.
something which is less than
Could
one
you?
year has a certain formula or maybe a constant, and something which is more than 1 year that has this formula, right? So you have
Okay.
effective exposure and all of that, and it's defined in detail. Okay.
Understood. Could you just quickly open the footnote below? The one footnote that's right below the formula, above it, the red box. The red box.
Okay.
Yeah. There's a footnote for the formula.
Yeah.
Yeah.
Conceptually, M equals the effective credit duration of counterparty exposure. Okay. So M is, so for example, if you understand bonds, right? Bonds have an effective duration, correct?
Okay.
So this is the duration equivalent of that counterparty credit exposure. So in other words, M will be number. I mean, M will be in years.
Oh, understood.
Okay. I mean, roughly. We will see exactly what it is, but we'll come back to that.
Yeah.
Okay. So you have MNS, right? Then EADNS is exposure at default of a netting set calculated the same way as bank calculates for minimum requirements. And DFNS is the supervisory discount factor. It is used one for banks using IMM to calculate EAD, uh, and is this for banks not using IMM. So some banks have a supervisory requirement to use internal market model, right? If that is the case, then they use one as a multiplying factor. If that bank does not use any internal market model, then they have this formula, right? So it is a function of MNS, which we just computed earlier, right? So and so on and so forth, right? So this is at a very high level, whatever number you will end up with here, correct? Let us say this is 100 million. So this much amount of capital you have to set aside for regulatory CVA requirement by a bank, right? You end up with let us say 100 million here, right? Then you have to set aside 100 million, and that 100 million is for CVA, correct? Now, with respect to that 100 million, whatever is the funding cost that you will charge in your model. I hope you understand the argument.
Yeah.
So if a bank has 100, uh, yeah. So if a bank has 100 trades, right? So for all the trades combined, there will be a CVA charge, and that charge will be charged into the trade price of trade. Okay. I hope everybody follows this. Just give me a second. So there is something called as Clarissoft. Okay, so Clarissoft is a very good. I mean, I have been following it for many things, and I found it good in terms of explanation, and they have certain basic Excels and all of that as well. Okay, so what Clarissoft mentions is, again, it's a reduced form of the same white paper which you already have, right? And they explain what is this and all of that, right? So uh, this CVA calculation, right? This has essentially three approaches. How to calculate CVA? Okay, there are three methods which are defined. So, so there is a basic approach. Okay, so let's come back here. Okay, so there are three approaches to calculate CVA. Okay, we look at these one by one, but currently we just list it down. Okay, what are the three approaches? So first one is basic approach. Basic approach for CVA. Okay, let us try to find what is the other approach. And there is called a standardized approach. Right, and then let us see that what is the third one. And then uh, I mean there is a subtype within basic approach which is called as a reduced version of CVA where hedges are not recognized. Okay, so this itself we can rewrite this as, no, this goes out, and this has two types. Okay, and the first one is where hedges are not recognized. So hedges not recognized.
Ajit, sorry to interrupt,
Yeah, go
but
ahead.
could you elaborate on the statement hedges are not recognized?
Yeah,
I'm a
yeah.
little
I mean,
with
that
that.
is going to be our full exercise, right?
Oh, okay.
So I'm just listing down a few things that what
Okay, okay.
I'm just putting a high level framework as to what we have to look at. Okay.
Understood, understood. I'll hold on to that question for later then.
Yeah. I mean, I have not gone through this paper fully. So hedges recognized. But I'm trying to go it in such a manner that it is structured and organized for us to understand. Okay.
Yeah,
So
fair enough.
for what we have to look at and what not. So if you say so if you say to someone that I have studied FRTB CVA, right? Then I think the first question they'll ask is what are the various ways to calculate CVA under FRTB, correct? So at a very high level, the answer is there's a basic approach where and which is further subdivided into two parts, which is hedges where hedges are recognized and where hedges are not recognized. And the second method is the standardized CVA, right? Our whole exercise of trying to understand CVA is going to revolve around understanding these three approaches of calculation of CVA. Okay. So what is it for hedges recognized, what is it for hedges not recognized, and what is it for standardized approach? Okay. So at a very high level, this is what we are going to do for next whatever sessions we have to understand as to what is happening. Okay. Let me share this also in our chat. So where is it? Let us go to our community. Okay. So this has a certain element of uh, understanding, right? So I mean this has been written so that everybody can follow, right, without putting in much effort. So here you have effectively this is what we have to look at, how to get at each of these numbers, right? So 1.4 is a calibrated number which is a constant which you don't have to bother about. You have to look at for a particular trade how to come up with RWC, how to come up with MNS, how to come up with EAD, how to come up with DFNS, right? And once we have all of this, will have a certain understanding as to what is the CVA term, right? And that consolidation is across counterparties. So if we look for basic CVA Excel, yeah, but this has a this has let us look for Claris. So before we even go to that, right? I mean, we'll not be looking for that example here because it will take some time. But before we go into that, I just wanted to suggest something. Uh, this is John Gregory, right? You can understand this guy as a very central guy to CVA, right? He has written lots of books and he contributes very actively to the regulatory development and all of that also, right? So here you have certain excels where he has provided a certain working calculations of a few things, right? And you can even go through these excels and try to understand. But for example, if anything you have to do within CVA, you are pretty much following something which was done by or contributed to by John Gregory, right? So and he himself has a this CVA Central named website where you can go and find a lot of resources as to how a few things are done, right? So this is CVA Central where he talks a lot about how to do things, right? So I'll also paste this. The best part is he has some working excels, and from those working excels we can understand how few things are done, right? So I mean, this is even a precursor to what the white paper has. Okay, so those white papers came up with a few parameters by using certain calibration, right? Even behind that calibration, what happens is what this is about, right? I mean, incidentally, this is also named as IR calibration, right? So calibration of interest rate curve and pre-calculations for one-factor Hull-White model. Okay, so a one-factor Hull-White model is used, MTM is calculated, and what is the potential positive exposure for that is also computed, right? So 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 this is the work that goes behind the scenes to come up with the white paper which you're seeing for the FRTB. Okay, if you want to understand that, so this is the place to come to and try to understand as to what's happening. He has done it beautifully, and you can understand how things work at behind the scenes. After the scenes, after the paper has been developed, it is simply implementation of what you see here. Okay, so I hope people get the very high level picture of what we are talking about and what we are discussing and what we are trying to achieve. Are there any questions so far?
So, not regarding the session, but more overall.
Yeah.
So, from here, do you have any further readings that you would recommend apart from what you just said, like something that's more simplified?
I think this is the easiest that it can go, right? So this is CBS
Okay.
Central. So this is from the guy who has developed the full theory from ground up. And you have a lot of
Okay.
I don't know how to get the hold of this book. I'm also looking for that. But if you could get
Okay.
hold of
I'll
this book,
search for the book. Wait.
yeah. So if you get the hold of the book, right, you will
Yeah.
understand the theory behind it, and Excel has the implementation behind it as to how to solve
Understood.
it and how to do it. Right? So that is the most comprehensive that you could get. So if you understand this plus that simultaneously, then this is the
Okay.
best you could get out of it.
Okay.
Okay, so I think if there are no more questions, we'll kind of close this call because I don't want to start a new thing and end it in the middle of it without uh, completing it. So we'll kind of end this call here. But given that we have a view as to what to do, right? So by next call, we'll at least I'll try from my end to understand what is basic approach for CVA where hedges are not recognized. Okay, and then
Yeah.
we'll try to do this calculation. Then we'll go to the hedges recognized thing, and then we'll try to go to standardized approach. After we are done with fully this white paper of FRTB, right, as issued by BIS, then we'll go back to John Gregory's book and try to see behind the scene what's happening. Why did we come up with that 1.4, right? Why we have a certain risk weight, how that was calculated. That we'll understand once we go through that book by Gregory. Okay. So that's it from my end. Uh, I'm recording this session. I'll also share the recording of it. But let us agree on going ahead in this direction in the next session. Yeah, thanks a lot everyone for joining. I'll share the recording of the session and we can continue our
Yeah.
discussion on the WhatsApp chat.
And please share the, what do you call it, the whiteboard as well.
Yeah, I'm just sharing it.
Yeah. Okay. Thanks a lot, Ajit.
Yeah, thanks
Okay.
everyone. Thanks.
Thank you. Thank you, Ajay.
Yeah, bye.
Bye.
Bye bye.